So far, 2025 has been an absolute rollercoaster. We have the most pro-crypto administration ever in Washington, D.C., but we've also had the largest hack by dollar value in crypto's history. BTC's price has crashed and recovered, and the Fear and Greed Index is up and down like a yo-yo. It's all a bit chaotic.
That's very chaotic.
Fortunately, though, a recent report offers a clearer picture of what's really going on in this unpredictable space. So today, we'll summarize this report in simple terms and tell you what it could mean for crypto in 2025. My name is Guy, and you're watching The Coin Bureau. The report we'll be summarizing for you today is titled, quote, Charting Crypto, and is for Q1 of 2025. It was co-authored by Coinbase, which needs no introduction, and Glassnode, a leading on-chain analytics company. As always, we'll leave a link to the full report in the description below, but we'll be giving you the highlights here in this video. Now, the report opens with some key market insights. According to the authors, a defensive strategy could be ideal in the short term as the market continues to trend lower. But things should improve in Q3 of this year when the market rebounds. The report adds that, quote, both BTC and the Coin50 index have recently broken below their respective 200-day moving averages, which signals potential bearish trends in the overall market. However, the report cautions that investors should take a tactical approach, since market sentiment will likely recover fairly quickly. The report also notes a few bullish and bearish catalysts that could move the market. On the bullish front, this would include the Fed ending quantitative tightening, or QT. This would add to global liquidity, with some of that money finding its way into crypto. Alternatively, an increase in stimulus from major global economies could also have a similar effect. On the bearish front, meanwhile, the answer is pretty obvious, and that's a continuation of the uncertainty surrounding Trump's tariffs, as this could cause global shocks that reduce market liquidity. More about Trump's tariffs in the description. Moving on. Next, the report gives a few insights from other major crypto companies, starting with Grayscale, a leading crypto asset manager. According to Grayscale, fees on application layer blockchains continue to rise, while the demand for decentralized applications, or dApps, continues to grow. Notably, there was a huge spike in fees generated by dApps in late Q4 last year, before falling dramatically. Next up is Tefra Digital, a digital assets investment company which looks at the restricted BTC exposure across major brokerages such as Fidelity, Vanguard, Morgan Stanley, JP Morgan, and Goldman Sachs, among others. According to them, many brokerages restrict their clients from being exposed to Bitcoin ETFs. But if they allow for even a 2% allocation to the spot Bitcoin ETFs, then this could mean unlocking anywhere between $440 and $765 billion in ETF inflows, 22x higher than in 2024. The catch, though, is that the data for these estimations is apparently, quote, based on private conversations with advisors at each brokerage. I guess we'll just have to take their word for it. Next, Multicoin, a crypto-focused investment firm, points out that in Q1 of this year, Solana generated more revenue than all other Layer 1 or Layer 2 blockchains combined, even after the meltdown of the Solana meme coin narrative. Note that Multicoin is a big investor in Sol. And finally, we have A16Z Crypto, the crypto-focused branch of venture capital firm Andreessen Horowitz. These guys decided to zoom in on the transaction volume of stablecoins after adjustments for inorganic participants, like bots. When adjusted, stablecoin transactions show a clear uptrend, reaching an all-time high in Q4 last year, which is expected to continue in 2025. Oh, and by the way, if you're enjoying the video so far, punch that like button, slap that subscribe button, and dropkick that notification bell so you don't miss our next one. Now, the next part of the report provides a general overview of the crypto market, starting with the market dominance of different cryptos. Notably, Bitcoin's dominance rose to 63% in Q1, its highest level since early 2021. As the report explains, this is because investors have largely been moving away from riskier assets and moving to BTC as a safe haven within crypto. Obviously, this is part of why Ethereum's dominance has been narrowing. Interestingly, the report says that this has been the case for around 6 months, but the chart provided suggests that ETH dominance has been noticeably declining since around July 2023. Meanwhile, Solana's market dominance has remained fairly stable since around the same time. Next, the report looks at the weekly inflows of the spot Bitcoin ETFs, which have been climbing consistently since they were launched in January last year. The chart provided shows that in total, there's been over $2.5 billion in cumulative inflows. What stands out to us, though, is the reversal this January, where investors were selling out of the ETFs thanks to, Trump's tariff turmoil. As for the spot Ethereum ETFs, meanwhile, you may recall that these had a rough old time when they were first launched back in August last year. However, they saw serious inflows between November and December, roughly $800 million worth, likely thanks to excitement around Trump's election victory. However, in Q1 this year alone, they also saw roughly $100 million in outflows. Ouch. The report also provides a chart that shows that, as far as spot Bitcoin ETF issuers are concerned, BlackRock is by far the largest holder of BTC with its IBIT fund. As for the spot Ethereum ETFs, BlackRock and Grayscale have roughly equal amounts of ETH in their respective funds, ETH-A for BlackRock and ETH-E for Grayscale. Next, the report looks at BTC's price performance in the current cycle, which the authors clarify started in 2022. What's strange is that they note that BTC's current price action was closely correlated to its performance in the 2015 to 2018 cycle, but has apparently diverged since Q1. However, from our perspective, the chart strongly suggests that BTC is still following that cycle very closely. If this is indeed the case, then this would be insanely bullish for BTC's price this cycle. As the price action for 2015 to 2018 suggests, BTC could still have plenty of room to run yet before reaching the cycle top. Although we should caveat that, just as is written in the report, past performance does not indicate future returns. So take it with a grain of salt. The report then moves to ETH's current performance relative to previous cycles, which is where things become far more apparent. Notably, ETH has been tracking its own price action from the 2018 to 2022 cycle, but has clearly decoupled from this price movement and is now moving down and to the right. To be blunt, this doesn't paint a very positive picture, especially when you factor in diminishing returns, which would suggest that ETH is heading, down only from here. The caveat is that we believe that momentum behind ETH could be building and could surprise everyone to the upside in the near future. And you can learn more about why ETH could be long-term bullish in this video right over here. Anyhow, the report then turns to stablecoins. What's crazy is that in the two charts provided, you can clearly see that USDT has the largest supply by a long shot, but the majority of stablecoin volume is actually in USDC. This suggests that DeFi is seeing some serious activity, since USDC is primarily used in things like borrowing and lending protocols, and also swapping. Then the report looks at the correlation between crypto and other major asset classes. It explains that crypto's correlation with stocks rose in Q1, but has displayed low or even negative correlations with other assets. For example, BTC's correlation to gold is just 0.05, which is incredibly low. Keep in mind that a full correlation would be a score of 1.
Well, hello there. I know you're enjoying the video immensely, but I just very quickly want to tell you about the Coin Bureau deals page. Now, if you're looking for some of the very best deals and promos in all of crypto, such as, for instance, up to $100,000 in sign-up bonuses and up to 60% in trading fee discounts on some of the top crypto exchanges out there, as well as insane discounts on hardware wallets and much more besides, then check out the Coin Bureau deals page in the description below. And now, back to the video.
The next part of the report looks at what's happening on-chain. First, it shows something called the entity-adjusted NUPL, which takes the net unrealized profits and losses and then removes any transactions between accounts belonging to the same entity. This gives us an idea of market sentiment. The report notes that in Q1, BTC moved from denial to anxiety, a bit like me when I consider going to the gym. Anyway, Next, the report looks at the percentage of BTC's held supply that's in profit. What's crazy is that almost every BTC holder was in profit at the start of the year, but by the end of Q1, more than a quarter of BTC holders were actually down on their investment. Then, the report looks at BTC's liquid and illiquid supply, where liquid means BTC that was moved within the last 3 months. BTC's liquid supply decreased in Q1, which suggests that investors accumulated more BTC when its price fell below $90,000 in February. The report then looks at BTC's realized price and MVRV, which requires a little explaining. So, the realized price is the average price of BTC based on its value on the day each coin was last transacted with on-chain. Meanwhile, the MVRV ratio, which stands for market value to realized value, measures the average unrealized profits and losses of Bitcoin investors. As the report explains, an MVRV value of 2 means that the average BTC holder is up by 2x. Meanwhile, an MVRV value of 1 means that investors are breaking even, and an MVRV of 0.85 means that the average investor is 15% down. Notably, the average realized price of BTC is somewhere around $45,000, and the majority of investors are up nearly 2x. Meanwhile, the report notes that throughout Q1, the total supply of BTC in a loss went from fewer than 500,000 to over 4 million BTC. Okay, the next part of the report switches from Bitcoin to Ethereum, starting with ETH's NUPL, which you'll recall stands for Net Unrealized Profits or Loss. The report explains that throughout Q1, ETH moved into a capitulation stage, and when it comes to labels for market sentiment, capitulation is the lowest end of the scale. Anyhow, the report then looks at how much of ETH's supply is sitting at a profit. Notably, more than 90% of ETH holders were in profit at the start of the year, but thanks to the recent sell-off, this number dropped to just 45%. Next, the report examines ETH's liquid supply, which rose by 15% in Q1 of this year. Meanwhile, ETH's illiquid supply fell by 2%. This means investors who have had long-term positions in ETH have been feeling extreme FUD and have begun moving their ETH positions around, either for staking to earn a yield or to exchanges to sell. More evidence of capitulation. The report then looks at Ethereum's MVRV, which you'll recall stands for market value to realized value. The report points out that, quote, ETH's MVRV turned negative in Q1 for the first time in 2 years. This means that ETH investors are sitting at a loss on their positions relative to what they paid on the market, albeit only just. The report then looks at the total supply of ETH sitting in loss. Notably, it highlights that by the end of Q1, more than 40 million ETH were sitting in loss, but something even more noticeable is seen on the chart provided. That's because this chart clearly shows that shortly after January, roughly 5 million ETH were sitting in loss. This amount then skyrocketed to over 40 million, all in the space of a few weeks. Crazy stuff. Next up, the report looks at Ethereum's Layer 2 ecosystem. The chart provided shows that there were around 14 million transactions across Ethereum and its Layer 2 protocols at the end of Q1 this year. The chart also shows that Ethereum transactions reached a peak of 18 million somewhere around Q3 of last year. The chart also shows that the vast majority of transactions were done using Base. You might also notice that Arbitrum and Tyco supported a good chunk of Ethereum transactions, while Ethereum itself facilitated just a small fraction of the overall total. Then the report shows the monthly user fees across Ethereum and its Layer 2s. We couldn't help but notice that the labels on the bottom of the chart are positioned incorrectly, which makes things a little confusing. We've added the correct months to make things a little easier. Anyhow, we can clearly see that Ethereum transactions spiked in a big way back in May 2023, where user fees amounted to more than 250,000 ETH. It's also clear that user fees have been ramping down in a big way since December 2024. Specifically, these fees fell from roughly 70,000 ETH to roughly 20,000 ETH. Damn. The report then looks at the total amount of ETH being staked and the value of that staked ETH. By the end of Q1, there were roughly 34 million staked ETH, which was worth just under $15 billion. What's crazy is that there was actually an uptick in the amount of ETH being staked since the start of the year, despite ETH's price falling by more than 50%. The report then shows the annual staking yield for ETH, which you'll notice has been curving downwards since 2021. In fact, ETH's annual staking yield was around 14% in January 2021, which made staking ETH very lucrative. However, by January 2025, that yield had fallen to about 4%. Doesn't really offer the same appeal, does it? In fact, this is largely the reason why Ethereum has struggled to capture the attention of venture capitalists and institutional investors. That's simply because these whales can just as easily earn a yield of 4.5% by holding US Treasury bonds, aka US government debt, which is widely considered to be the safest investment out there. Meanwhile, ETH's value could easily depreciate, in addition to delivering a lower yield. And finally, the report ends by looking at the total value of ETH locked away in DeFi protocols using a 7-day moving average. Notably, the report specifies that this includes ETH, stablecoins, and altcoins locked in Ethereum smart contracts or in Ethereum-based dApps. The chart provided shows that the total value locked, or TVL, on Ethereum was roughly $45 billion at the end of Q1, with more than 25 million ETH locked in DeFi protocols. Although, it is hard to get a clear idea of exactly how much ETH, since the chart is labelled incorrectly. 25 million appears twice. Anyway, you'll also notice that the TVL in Ethereum's DeFi ecosystem has been rising gradually since January 2024, although this figure has dropped a lot since the start of this year. And with that, we've reached the end of the report, and we'll remind you that you can find the full thing down in the description below. For now, though, there's just one question remaining. What does all of this mean for the crypto market? Well, if this report is anything to go by, the rest of 2025 could be a bumpy ride. On the one hand, crypto seems to be in a transitional phase. Bitcoin dominance continues to rise, ETF inflows have been holding steady, and long-term hodlers are doubling down on every dip, despite all the wider market uncertainty. This suggests that investor confidence in BTC is still very much intact. On the other hand, though, ETH continues to struggle. Staking yields remain unattractive, and the massive shift of ETH into lost territory doesn't exactly inspire confidence, even when you consider how DeFi activity on Ethereum continues to rise, despite the negative sentiment around Ethereum itself. If you watched our recent video on crypto lending, you'll know that DeFi activity has made a strong recovery since the bear market, which could seriously support ETH's price and the broader altcoin market by extension. And you can learn more about the borrowing and lending sector in the video right over here. What's more is that Ethereum's upcoming Pectra upgrade, which is set to go live on the 7th of May, could be a major catalyst for ETH's potential recovery. That's because Pectra will introduce 11 Ethereum improvement proposals, or EIPs, that will improve its scalability through Layer 2s, while introducing a bunch of much-needed improvements to Ethereum's user experience, or UX. And you can learn more about Pectra by checking out the video right over here. As such, we believe ETH could take many investors by surprise, and this would massively improve the sentiment around altcoins as a whole. Combine this with a regulatory backdrop that's becoming increasingly bullish, and you realize that the altcoin season we've all been so desperately waiting for could manifest itself in some way or another. Of course, though, this ultimately depends on macro conditions, which could potentially be more bullish than many are expecting. That's because the recent market volatility caused by Trump's tariffs has resulted in the Federal Reserve effectively confirming that it would stabilize the bond market through quantitative easing, or QE, if deemed necessary. This would seriously support liquidity conditions in the market. Not only that, but the Fed's most recent interest rate forecast note that it plans to lower rates by the end of the year. If inflation rates come in lower than expected and the economy continues to struggle with uncertainty, the Fed could opt to put this plan into action much sooner. Ironically, the Fed's next policy meeting is also on the 7th of May, the same day that Pectra goes live. So if the Fed is more dovish than expected, then make no mistake, this could cause cryptos everywhere to pump. So mark your calendars, folks, because the crypto market could be at a pivotal moment. Okay, if you enjoyed that video, you know what to do. Hit up that like button, smash that subscribe button, and turn on those notifications too so you don't miss our next one. If you want to learn more about the potential catalysts that could pump the crypto market, then you can check out this video right over here. And if you want to learn more about how institutional investors are eyeing up crypto, then this video right over here has you covered. Thank you all for watching, and I'll see you in the next one. This is Guy, signing off.